There's a single line buried deep inside your bank's fee schedule. One sentence, maybe 14 words. It's not something Chase explains when you open an account. It's not something Bank of America highlights in the welcome packet. It's not something Wells Fargo sends you a notification about. And it's definitely not something Capital One puts front and center when you log into your account. But that one sentence may be costing you money every single month. It's called a maintenance fee. And whether you use your checking account every day or barely touch it at all, that fee can quietly pull money out of your account month after month. No warning, no phone call, no alert telling you it just happened. For millions of people, the money simply disappears and life moves on. The numbers add up fast. Across the different fees we'll cover today, the average American household can lose anywhere from $400 to $900 every year to charges they never agreed to, never noticed, and never stopped to question. Here's the part that surprises most people. None of this is secret. Every fee is listed in a disclosure document that banks are legally required to provide. They printed the document. They filed the paperwork. They followed the rules. But they also built the entire customer experience around one simple assumption, that you will never read it. They are counting on you never opening that document. So today we're going to open it. This isn't a rant about banks, it's an audit. We're going fee by fee through the charges hiding inside the average checking and savings account. We'll look at what each fee costs over a year, what it can cost over a decade, who gets hit the hardest, and most importantly, how to eliminate it. Some fees can be removed with a single phone call. Others disappear with one settings change. Some require nothing more than switching to a different account. By the end of this video, you'll know every fee your bank is quietly collecting from you and the exact sentence to say to make each one stop. Section 1, the monthly maintenance fee. Let's start with the flagship fee, the monthly maintenance fee. This is the fee many banks charge simply for keeping your checking account open. In most cases, it ranges from $10 to $15 per month unless you meet certain conditions. Maybe you need to keep a minimum balance. Maybe you need a direct deposit every month. Maybe you need both. At first, $12 doesn't sound like much. That's exactly why it works. But $12 a month becomes $144 a year. Leave it alone for 10 years and you've lost $440. And that's before you count the interest or investment growth that money could have earned if it had stayed in your pocket. Take Marcus, for example. He's 34, works full-time, pays his bills on schedule, and checks his account often enough to make sure nothing looks wrong. One day, he noticed his balance seemed lower than expected. After scrolling through months of transactions, he found the same charge appearing again and again. A maintenance fee. He wasn't overdrawn. He hadn't broken any rules. He had simply missed one of the bank's waiver requirements. That's how these fees work. The conditions are usually designed to sound easy. Keep a certain balance, set up direct deposit, maintain account activity. But life is rarely perfectly consistent. A job change, a missed paycheck, a large bill, or a temporary drop in savings can push someone below the threshold for a month. And when that happens, the fee arrives right on schedule. Banks know that most customers will meet the requirements most of the time. They also know that a percentage will slip, not every month, just often enough. Think of it like a toll road with a free pass that only works if you follow every rule perfectly. Miss one condition, and the toll gets charged automatically. The good news is that this fee is usually one of the easiest to remove. A quick phone call, a different account type, or a switch to a bank with no maintenance fees can often make it disappear. But maintenance fees are at least visible. If you look closely, you can find them. The next fee is different. It's one that almost nobody notices until the damage is already done. Section 2, the paper statement fee. The next fee looks small enough to ignore. That's exactly why it survives. It's called the paper statement fee. Many banks charge between $2 and $5 every month to mail your account statement to your home. On its own, a few dollars does not sound like a problem. But at $3 per month, that's $36 every year. Over 10 years, that's $360. At $5 per month, the total grows to $600 over a decade. All for receiving information the bank is already sending electronically. The surprising part is how many people never choose this option at all. When most customers open an account, they focus on the important things: their debit card, their password, their first deposit. Very few people spend time digging through account settings looking for statement preferences. And that's where the choice is often hidden. Instead of clearly asking during sign-up, many banks place the paperless option inside account settings, several clicks away from the screens most people ever visit. If you never go looking for it, the paper statements keep arriving, and the fees keep coming with them. The people hit hardest are often the people who can least afford it. Many older adults are more comfortable reading paper than using an app. Some customers have limited internet access. Others simply trust a document they can hold in their hands. They are not doing anything wrong. They are choosing the method that feels safest and easiest for them. Yet they are often the ones paying extra for that choice. Think of it like paying a monthly subscription for a feature you never asked for. The service keeps running in the background, quietly taking a few dollars at a time. The fix is usually simple. Log into your account, find your statement settings, and switch to paperless delivery. If you cannot find it, call the bank and ask them to do it for you. At least this fee leaves a trail. It usually appears right there on the statement you're paying to receive. The next fee is harder to spot, because it often doesn't appear where most people would ever think to look. Section 3, the Overdraft and Insufficient Funds Fee. Now we come to one of the most expensive fees in banking, the overdraft fee. At many major banks, a single overdraft can cost around $35. That sounds painful enough, but the real problem is not the fee itself. The real problem is how one small mistake can turn into several fees at once. Imagine you have $100 left in your checking account. On the same day, you make a large purchase for $110. Later, you buy lunch for $12, grab a coffee for $5, and pay for parking for $3. Most people would assume the transactions are processed in the order they happened. But for years, many banks processed larger payments first. That $110 purchase would hit the account before the smaller purchases. Now your balance is below zero. When the lunch, coffee, and parking charges arrive, each one can trigger another fee. Suddenly, 3 small purchases create 3 separate $35 charges. That's $105 gone in a single day, not because of what you bought, but because of how the transactions were handled. Over time, the damage grows. A person who overdrafts only once every couple of months could lose hundreds of dollars a year in fees. Money that could have gone toward groceries, bills, savings, or debt payments instead disappears into penalties. Regulators eventually stepped in after years of complaints and lawsuits. Banks faced pressure to change practices that made overdraft fees pile up. Many institutions adjusted their systems, added more disclosures, or changed when certain fees could be charged. But notice what happened. The rules changed just enough to meet the requirements. The fees did not disappear. Think of overdraft fees like falling into a hole and getting charged every time you try to climb out. The deeper the hole, the harder it becomes to recover. The best defense is simple. Turn on low balance alerts, link a savings account for backup transfers if available, and opt out of overdraft coverage when it makes sense for your situation. At least overdraft fees require you to run out of money first. The next fee works differently. It charges some people for doing the exact opposite, for letting too much money sit still. Section 4, the Inactivity or Dormancy Fee. Most bank fees happen because you use an account. This one happens because you stop using it. It's called an inactivity fee, sometimes called a dormancy fee. And it often shows up in old savings accounts or secondary checking accounts that have been sitting untouched for months or years. Here's how it works. You open a savings account, put some money into it, and then life gets busy. Maybe you switch banks. Maybe you move. Maybe you simply forget the account exists after a set period with no activity. Some banks begin charging a dormancy fee. It might be $5 per month. It might be $10. Either way, the money starts leaving the account automatically. And because the account is already forgotten, many people never notice. Imagine an old savings account with $200 sitting inside it. A $10 monthly dormancy fee removes $120 every year. In less than 2 years, that $200 balance can be completely wiped out. Not by a market crash, not by inflation, by fees. Think about how strange that is. The money's not being borrowed. It is not being invested. It is simply sitting there. Yet the balance keeps shrinking month after month. If the account remains inactive long enough, another process begins. It's called escheatment. That is the legal process where abandoned funds are turned over to the state. If an account stays dormant for years and the owner cannot be reached, the remaining money may eventually leave the bank and be transferred to the state's unclaimed property system. The money does not disappear forever, but recovering it can require paperwork, searches, and proof of ownership. The lesson is simple. Silence has a cost. Banks send disclosures. They send notices, but they know many people stop paying attention to accounts they no longer use. The less attention an account gets, the easier it becomes for fees to quietly eat away at the balance. The fix is easy. Review every account you own at least once a year. If you no longer need an account, close it. If you want to keep it, make a small deposit or withdrawal from time to time. This fee punishes you for ignoring an account. The next fee punishes you for using one the wrong way. Section 5. The excess transaction fee. This next fee is one of the strangest on the list, because it survives even though the rule that created it is mostly gone. For years, A federal rule called Regulation D limited certain types of withdrawals and transfers from savings accounts. In simple terms, many people could only make up to 6 convenient withdrawals or transfers each month before running into problems. Then, in 2020, the Federal Reserve suspended that limit. Most people assumed the fees would disappear too. Many didn't. A surprising number of banks kept their excess transaction fees in place. Go over the bank's limit, and you may still be charged $10 to $15 for each extra withdrawal or transfer. Think about someone who uses a savings account as a safety cushion. Maybe Sarah keeps emergency money in savings and moves small amounts into checking whenever unexpected expenses show up. A car repair one week, a medical bill the next, a school expense after that. By the end of the month, she has made several transfers. One extra transfer might trigger a $15 fee. 2 extra transfers could cost $30. 3 could cost $45. And all she was doing was moving her own money between her own accounts. Over a year, those charges can easily grow into hundreds of dollars for someone who regularly treats savings as a flexible backup account. The reason this fee continues to work is simple. Most customers still believe it is required by law. They remember hearing about withdrawal limits years ago and assume nothing has changed. The fee feels official, so they rarely question it. But there is a difference between a government rule and a bank policy. Many people never stop to check which one they are paying for. Think of it like a bridge toll that remains in place long after the bridge has been paid for. People keep paying because they assume the charge must still be necessary. The solution is to review your account terms carefully. Some banks have removed these fees entirely. Others still charge them. Knowing the difference can save you money with almost no effort. So far, we've seen banks charge you for leaving money alone and for moving your own money out. Next comes a fee that can appear when you try to move money in from the wrong place. Section 6, the incoming wire and external transfer fee. Most people expect to pay a fee when they send money. What surprises them is getting charged when money comes in. This is the incoming wire fee. At many banks, receiving a wire transfer can cost anywhere from $15 to $25. Some institutions also charge fees for certain transfers coming from external accounts, even when the money is moving between accounts that belong to the same person. Think about who this affects. Freelancers, contractors, small business owners, side hustlers, people with income coming from several places instead of one employer. Let's say you're a freelance designer and receive 2 wire payments each month from clients. If your bank charges $20 per incoming wire, that's $40 every month. Over a year, that's $480. Over 10 years, that's $4,800. And remember, that money is not paying for a loan, an investment, or a special service. It is simply the cost of receiving money that already belongs to you. For someone building a business or trying to grow a second income stream, those charges can quietly eat away at profits month after month. Banks usually describe these fees as processing costs. That sounds reasonable at first. After all, moving money must cost something, right? But here's the important point. The actual cost of handling many electronic transactions is extremely small. In many cases, the technology does most of the work automatically. The cost to process the transfer is often measured in pennies, while the customer may be charged $20 or more. Think of it like paying a parking fee every time someone delivers a package to your house. The package is yours, the delivery is complete, yet you are still charged for receiving it. The best defense is to know how your bank handles incoming transfers before you accept payments. Some banks charge these fees, others do not. A simple account change can sometimes eliminate the cost entirely. Every fee we've covered so far has lived inside your main bank account. The next one is different. It hides inside a product many banks sell as a helpful feature, and that is exactly why so many people never question it. Section 7, the account upgrade fee. By now, you may have noticed a pattern. Many bank fees are sold as solutions, and few examples show that better than the premium checking account. At some point, many customers receive an offer to upgrade. The account gets a new name. Maybe it is called a relationship account, a premier account, or a premium banking package. The marketing promises extra benefits, special treatment, and a better banking experience. What it rarely highlights is the new monthly fee. Instead of paying $10 or $15 per month, the upgraded account may cost $20 to $30 every month. That means $240 to $360 every year. To avoid the fee, customers often need to maintain very large balances. In some cases, the waiver requirements can reach $50,000 to $75,000 across checking, savings, and investment accounts. For many households, that is a difficult target to hit consistently. Now let's look at what customers receive in return. The perks often include things like free cashier's checks, discounted services, or a slightly better interest rate on savings. Those benefits sound valuable, But for many people, the actual value is surprisingly small. A person who uses a free cashier's check once or twice a year and earns a little extra interest on savings might receive benefits worth only $40 or so annually. Meanwhile, the account fee could be costing them $240, $300, or even $360 every year. It's like paying for a luxury gym membership when you only use the water fountain. The real product being sold is not always the benefits. It is the feeling. The feeling of being a premium customer. The feeling of having access to something more exclusive. Banks understand that people naturally connect higher-priced products with higher status. A larger fee can make an account feel more important, even when the math does not support the upgrade. That doesn't mean these accounts are never worth it. For some customers with large balances and complex banking needs, they can make sense. But for many people, the upgrade costs far more than the benefits provide. At least this fee is attached to a product you agreed to open. The final fee is different, because your bank can add it without ever asking for your permission. Section 8. The clause there is one final detail almost nobody talks about. It is buried deep inside the account agreement. Most banks include a clause that allows them to change their fee schedule in the future. They can add new fees, they can raise existing fees, they can adjust waiver requirements, and in many cases, the only thing they are required to do is provide notice. That sounds fair until you look at how notice often works. Many people imagine a clear warning, a phone call, a large message on the home screen of their banking app, a letter that demands attention. Instead, written notice can be something as simple as a small insert inside an e-statement, a message tucked into a document you never opened, a disclosure buried among pages of information most customers never read. Legally, the notice was delivered. Practically, it may never have been seen. And that is the real reason the fees we covered today continue to exist. This video was never really about maintenance fees, paper statement fees, overdraft fees, dormancy fees, transfer fees, or premium account fees. Those are just symptoms. The bigger story is the system behind them. A system where silence often equals consent. If customers do nothing, the fees continue. If customers never review the disclosures, the charges remain. If customers never ask questions, the rules stay exactly as they are. Think of it like a subscription that automatically renews every year. The company does not need you to say yes again, it only needs you to stay quiet. The good news is that you can break that cycle. Start today. Download your bank's current fee schedule and read it from top to bottom. Then call your bank and ask for a line-by-line review of every fee that applies to your accounts. You may be surprised by how many can be removed, reduced, or avoided. Finally, set a calendar reminder to repeat this process every 12 months. 1 hour of review each year can save hundreds of dollars over time. Remember how we started this video. They printed the fee schedule. They filed it. They made it available. But they were counting on you never opening it. Now you have.